Investors love the 12% dividend yield on the QYLD and other high-yield stocks. But what if I could show you a stock that earns a yield of 30% for its investors? You'd get excited, right? You're damn right you'd get excited. You'd be naming your firstborn after me. I'm using a new way to find high-yield stocks, not on cash flow yield like dividends, but on the total earnings power of a company. And when I explain why, it is going to change the way you think about investing. I want to get started on our list of those highest yielding stocks, but stick around because later I'll show you why earnings yield is so important, how to use it in your analysis, and reveal the true yield on the most popular stocks like Apple, Microsoft, and Google. And it might change how you think about these companies. The lowest earnings yield on our list, homebuilder D.R. Horton, ticker DHI, at a 13% yield, and I'm going to show you how to find that yield next. But even that, the lowest yield on our list of stocks to watch is still more than 6 times the earnings yield you'll earn on some of those most popular stocks that we'll look at later. Horton has been the largest homebuilder in the United States for more than 2 decades, and with a commanding share in top markets. Market share higher than 10% in its top 5 areas, including Dallas, Houston, and Atlanta. The rate on the 30-year mortgage has doubled over the last year, which has slowed home sales with just 683,000 sales reported in April. But demand and prices are holding up because of that massive housing shortage. More than 15.6 million new households were formed in the decade through last year, but only 11.9 million new homes were built. That gap of 3.7 million homes adds to the existing shortage for a 6.5 million gap in single-family homes. Now that's going to mean even as the housing market cools further, D.R. Horton will still see demand for new construction. Management is guiding to as much as $33 billion in 2023 revenue, flat from last year, but impressive in this kind of tough environment. Even on that no-growth scenario, the company generates over $1.4 billion in free cash flow and has announced a $1 billion share buyback program that'll support earnings per share. The 0.93% dividend yield isn't much of a cash return, but that 13% total earnings yield is one you want to watch. We've still got 6 more stocks to highlight, but I want to explain this measure of earnings yield and why it is so important, because this is something that is going to change how you invest. I also want to thank Hogue, CEO of Stockcard, and her channel, the Do Your Research channel here on YouTube, for downloading the financial statement data I used for this video. I'll leave a link to her channel in the description as well. Earnings yield, it gets to the very heart of what it means to invest. Now you know about dividend yield, right? That's the annual dividend you receive divided by the share price. For example, shares of Realty Income, you get that $3.06 per share in dividends over the 12 months. On a current stock price, that's a yield on your cash return of almost 5.2%. But earnings yield gets to the very heart of what it means to invest. And it's because stocks are so much more than just a quick dividend return. As an investor, you own a piece of that company and a right to all the future earnings produced, not just what is returned as a dividend. So if we're only looking at a dividend yield, we're missing a crucial piece of that return as an investor. And that is where the earnings yield comes in. With this, you're going to be able to find the stocks rewarding you with that highest total return in the market. So earnings yield is the total profit return you earn as an investor in the stock. It's the earnings per share, what you own as a stock owner in that company, divided by the value of the company on a price per share basis. Now there are a couple of ways you can do this, and I'm going to explain both so you get a good idea. The simplest way is just the last year's earnings per share divided by the stock price. So if you go to Yahoo Finance and scroll down here, you're going to find the last 4 quarters earnings for a company, and we'll add these up for D.R. Horton to find it produced $14.83 in per share earnings over the last year. Then we just take that divided by the share price of $108 each to get an earnings yield of 13.7%. But I prefer to do this a different way. It's a little more complicated, but still easy, and accounts for companies with a lot of debt. Here you go to the Statistics tab, and you'll find the enterprise value of the company. Now this enterprise value, or EV, is the market value of the shares, but it also accounts for all cash and debt on the company's balance sheet. Now, the problem here, folks, is if you're not accounting for all that debt that the company owes, then you're not getting a true measure of the return or the yield. So here, I want to take the EV, then scroll down and divide by the number of shares outstanding to get that enterprise value per share. Here we have an EV for DHI of 39.6 billion and shares outstanding of 341 million shares, or an EV of $116 per share. Now from there, it's just the same. Just divide that $14.83 in earnings by $116 per share to get that true earnings yield of 12.8% for DHI. I know this seems overly complicated, but it just gives you a better measure of that true earnings yield, especially for some of these very highly indebted companies. A last note, and we'll get back to our list, but notice this earnings yield doesn't account for earnings growth, which as an owner of those future earnings is hugely important in investing. That's why you want to use something like maybe the PEG ratio or the price to earnings to growth ratio as well when you're picking your stocks. Start with this earnings yield measure, then find the stocks also growing their earnings to give you the best of both worlds. Current yield plus future return growth. Next up is one of my favorite ways to play the electric vehicle revolution, Albemarle Corporation, ticker ALB. Understand that the big bottleneck in the electric vehicles right now is not car production, but batteries, with the price of lithium surging. That's because we're facing a severe shortage of the metal. Standard & Poor's estimates that even if all 53 lithium projects are developed, we'd still be looking at a deficit of 600,000 tons by 2030. With the increase in EV sales, we're already in a deficit on existing mines, and it's only going to get worse, driving up the cost and slowing production of green technologies. In fact, this shortage is expected to be so bad that Chile is planning on nationalizing its lithium industry, putting state control on all projects by 2030. The news sent major lithium miners like Albemarle and SQM down 15% or more on a single day. And this is why I'm also investing in potential alternatives to lithium batteries. But until the day comes when we have a kind of scalable alternative, miners like ALB will be cash machines. Albemarle owns best-in-class resources across the US and South America, and more importantly, an integrated model with conversion capacity global. It's going to benefit from the prices at every point in the supply chain. Revenue is expected 37% higher this year to $10 billion, and while analysts are forecasting flat growth next year, I don't know how it slows down with the kind of growth in electric vehicle demand expected. EVs are just 7% of total vehicle productions now, but expected to grow to 30% by 2030. That's more than 3 million more cars a year. ALB has a market cap just under $23 billion, with more than $1.5 billion in cash and $3.2 billion in debt. Again, the cash return here is pretty meager, but you get a 15% total earnings yield with shares of ALB and that potential to grow into that lithium demand. Next here is one of my favorite value plays, shares of Citigroup, ticker C, and a solid dividend yield. Citigroup is the third largest bank in the United States with over $1 trillion in U.S. assets and $1.7 trillion globally. And despite the crisis at regional banks, big banks have been doing pretty well. Net interest income and deposits both grew by more than 2% on a year-over-year basis, and deposits increased through that first quarter. Now this chart is a little busy, but offers a lot of great information, including balance sheet metrics at the bottom. The bank recorded just $264 billion in held-to-maturity securities in the first quarter. Now that's the line item destroying the regional banks, because that fear is that the bond portfolio isn't worth nearly as much as is reported, but with just $264 billion here and liquid resources of more than $1 trillion, the bank is in no danger. We also see that tangible book value per share of $84, which means at a share price of just $45 each, the stock is trading for just 0.53 times book value, deep into value territory. Now, Citigroup doesn't post the highest returns in banking, with a return on tangible equity around 10.5% versus something closer to 17% for JP Morgan and Bank of America, but it's definitely the least expensive, and that could make it a better deal. Now, because the way banks report their assets and liabilities differently compared to other companies, here, instead of using that enterprise value, I did use the traditional measure for that earnings yield with just the earnings per share and the share price. That gives us a strong 16% earnings yield for Citigroup, but you also get a 4.6% cash return just for holding the shares. We're just getting started on our list of highest yielding stocks, but Nation, I do not want you just to jump into these stocks just because you hear them here. There are a lot of yahoos here on YouTube, and following them blindly into a stock pick does not make for a good investing strategy. That's why I want to get you started with a quick start guide to the analysis I do when I'm looking for stocks to buy. I'll leave a link below in the description to the step-by-step guide to the 5 points you need to look for and how to find each. This is the analysis I learned how to do through more than 10 years as a venture capital analyst and in private wealth management. It's totally free. Just follow the link below. Nation, my goal for this channel is not just to give you a few stock ideas, but to make you a better investor, so do not pass up your chance. Nucor Corporation, ticker NUE, is a diversified steel company with an impressive dividend history. The company is part of the Dividend Aristocrats list, increasing its payout for 49 straight years, almost putting it on the list of dividend kings. Nucor has the scale and diversification of products to benefit at multiple points in the supply chain across North America. A struggling U.S. and global economy has weighed on steel demand and prices this year, but we could start seeing a pickup as funds from that trillion-dollar infrastructure bill are put to work, as well as just a general economic rebound next year. Steel prices may weaken into a recession, but with Nucor, you're getting almost an 18% earnings yield and a 1.5% dividend to wait on the shares. High oil prices last year put a lot of energy companies on the list, with Marathon Petroleum, ticker MPC, one of the best. Marathon is a downstream oil company, which means rather than pump the stuff out of the ground, it owns the refineries and storage facilities as well as a pipeline network through its MPLX ownership. The company has nearly 3 million barrels a day of refining capacity and has managed to stay nearly full at 96% utilization. It's got the strong exposure to natural gas liquefaction play as well, with 19,000 miles of pipeline. In fact, adding MPC to a portfolio with an upstream producer like Chevron and then retailer like Phillips gives you the entire process from exploration to customer in energy. Marathon produced over $4.1 billion in operational cash flow in the first quarter alone, helping to send $337 million to investors as dividends and repurchase $3.1 billion in shares. The company also authorized another $5 billion in share repurchases for the future. Now here again, with lower oil prices, the earnings will come down a little, but we're still getting into that high double digits now with 22% earnings yield on shares of MPC, along with its 2.9% dividend. We're coming up on the highest two earnings yield stocks, but stick around to see the yield on those most popular stocks like Apple and Microsoft, because the truth is gonna shock you. Make sure to join the community by tapping that subscribe button, because I'll be doing a follow-up video to this highest yielding stocks by sector. Most of these stocks that we saw in this video are just from 3 sectors: energy, materials, and financials. But loading up on just those misses out on growth in other sectors, so don't miss that next video where I'll reveal the highest earning stocks in each part of the market. Back to our list though, and one of my favorite oil stocks here with Phillips 66, ticker PSX, and not only one of the highest earning yielding stocks, but also one of the highest dividend yields in the group. Now, I like Phillips because it's got more of that diversified revenue stream than you see in most large oil companies. Besides the familiar retail gas stations, the company has refineries, midstream pipelines, and chemicals business that really sets it apart. It can use that integrated network to avoid those supply chain disruptions, get better pricing, and better returns for investors. The company is finishing up its acquisition of pipeline operator DCP Midstream, which is going to give it a total of 72,000 miles of pipeline, adding a critical transportation network and fee revenue to the mix. Phillips is committed to its shareholder cash return, targeting $12 billion in dividend payments through 2024, and already returning over $34 billion to investors through dividends and share repurchases. Now, the price of oil has come down this year compared to last year, but it will bounce back with any economic growth. Phillips has $7 billion in balance sheet cash against just $17 billion in debt, or an enterprise value of $115 per share. And that means on $26 in earnings, it's producing a 23% earnings yield, along with that strong dividend play at 4.6% cash return. And the highest yield on our list, Valero Energy, ticker VLO, another great dividend and total yield stock. Valero is the world's largest refiner and second largest in renewable diesel and ethanol production. It's not quite as integrated as Marathon. This is more of a pure play to refinery operations, but it does have some pipeline and terminal capacity. Valero has consistently returned cash to shareholders with $1.6 billion in dividends and $4.6 billion in share repurchases just last year. Reducing that share count through those repurchases means that earnings are shared across fewer investors, increasing that earnings yield. Valero tops our list with a 29% earnings yield, along with its solid 3.6% dividend yield while you hold the shares. And here we see the earnings yield from some of the largest and most popular stocks like Apple, Microsoft, Amazon, and Tesla, and that the biggest may not be the best yield for your money. Of course, the caveat here is what I talked about earlier, that the earnings yield measure doesn't incorporate earnings growth, so there's still something to be said for these companies that can grow their earnings by double digits a year. But now, even accounting for that faster earnings growth on some of these, for example, the analysts expect NVIDIA to grow its earnings by a whopping 76% annually over this year and next, but does that make up for only earning 0.5% right now on the shares? Even on $10 per share earnings expected in 2025, the yield would just be 2.6% and still far below what you earn on some of these highest yielding stocks. Don't neglect these faster growing companies, but also don't pass up your chance to earn a higher yield right now. Get your free quick start analysis guide with the link below, or click on the video to the right for the 4 dividend stocks that will put cash in your pocket every single week. A simple 4-stock portfolio for weekly dividends. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.